Hi, my Bitcoin followers! Every day we listen to reports on various news platforms about this or that with regards to cryptocurrencies, and with the recent market correction, the market has been in a state of confusion. But that's exactly the issue. Everyone seems to be pointing out the problem, but no one actually seems to be keen on providing solutions. That's why today we will be giving you a complete guide on trading with Bitcoin. Without further ado, let's begin. In late 2009, $1 was the equivalent of over 1,300 Bitcoins. From being valued at a fraction of a dollar, one Bitcoin crossed the $10,000 valuation price point within 8 years, an abnormal rate of return by every measure. By late 2017, Bitcoin became a household name as it flirted with the $20,000 price level. Bitcoin, alongside other cryptocurrencies, was now a must-have in the portfolios of every investor. Late investors, however, watched in horror as the entire crypto market retraced after years of incredible gains by 2018. Cryptocurrencies became mainstream financial assets though, and the pullback would later prove to be short-lived. Like any financial asset, the price of Bitcoin is dictated by the laws of supply and demand. Bitcoin has always been compared to gold in this regard, in that there is a finite number of coins that will ever be available. Beyond that, market participants will, over time, determine the fair value of Bitcoin depending on its use cases and adoption. Another major price influencer is media coverage. In its early years, the price of Bitcoin was constrained as the media branded it a passing cloud and a coin of the dark web. In this age of social media, such negative coverage can scare potential investors. However, positive media coverage of both Bitcoin and its underlying blockchain technology has provided favorable fundamentals for the foremost cryptocurrency and emboldened investors. Bitcoin trading may be decentralized, but the power of major governments around the world cannot be ignored. Bitcoin has been the subject of frequent changes and regulations in various aspects, including taxation. Part of the reason the price of Bitcoin fell sharply after the highs of late 2017 was massive regulatory pressure from China. But regulation is not necessarily a negative fundamental. In some instances, positive regulations serve as a tool to legitimize Bitcoin as a mainstream financial asset, and this can lead to increased demand. Bitcoin's price is also influenced by what happens within the Bitcoin community. Part of the reason the price of Bitcoin surged during the COVID-19 pandemic can be linked to the halving that happened in May 2020. Bitcoin halving is when the reward for mining Bitcoin is halved. This theoretically limits the supply of Bitcoin as the incentive of mining is reduced. With supply limited, demand increases, and the price of Bitcoin increases as well. Bitcoin is a highly volatile asset, with changing sentiment capable of driving prices from one extreme to another. The market can experience overzealous optimism one moment and then quickly change to dark pessimism. At the end of the day though, investors have to file their taxes whether prices are rising or falling. Luckily for investors, Bitcoin is subject to capital gains tax. This presents a unique opportunity for claiming tax deductibles when prices are plunging. If you suffer a loss from your Bitcoin investment, you are entitled to include the details so as to reduce your overall tax liability. For a Bitcoin loss to be valid, it has to be realized. This means that you have to liquidate your position. You can only suffer a loss when you sell Bitcoin at a lower price than you bought it. If prices fall but you do not sell, this is an unrealized loss and does not qualify for tax deduction. For instance, if you had bought one Bitcoin at $40,000, but the price is now $35,000 and you sell it, you will have realized a loss of $5,000. If you file your returns, you can claim a capital loss worth $5,000. In the US, capital losses can be claimed up to a maximum of $3,000. But the good thing is that excess loss can be rolled over to subsequent years indefinitely. So, if in 2020 you suffered a loss of $5,000, you are entitled to tax deductibles up to $3,000, and you can carry forward the additional loss of $2,000 to 2021. Bitcoin and other cryptocurrencies are inherently volatile. The good days are cherished, but the bad days need not be stressful. By using this tax harvesting trick, you will be able to reduce your tax liability when Bitcoin prices fall. There are different ways of buying Bitcoin and gain exposure to the opportunities this exciting asset provides. There are crypto exchanges that allow investors to buy Bitcoin using credit/debit cards or bank transfers. Exchanges were initially the only way to buy Bitcoin, and they have evolved as the foremost cryptocurrency has attained interest globally. When you buy Bitcoin via an exchange, you will be required to open and secure a crypto wallet. You will fully own the coins and can benefit from forks that generate dividends for Bitcoin holders. If you are enjoying this video, then make sure to hit the like button and subscribe to the channel for more interesting videos about Bitcoin. There are also peer-to-peer Bitcoin exchange sites where people trade Bitcoin for cash between each other. These sites have grown in popularity because they match local traders who can conveniently exchange Bitcoin using local payment methods. Peer-to-peer Bitcoin trading sites usually offer the coin at premium prices, higher than the market spot price, but they are easy and convenient for anyone to use. There are also Bitcoin ATMs that resemble traditional ATMs. However, they are not connected to any bank, but rather to a Bitcoin wallet or exchange. Bitcoin ATMs allow investors to buy Bitcoin with debit/credit cards as well as cash. In most cases, it is easy to locate Bitcoin ATMs near you using maps. While this may increase convenience for some, many Bitcoin ATM users have lamented the high fees charged, usually more than 5%. With Bitcoin becoming a mainstream financial asset, investors can also be exposed to its price changes by trading Bitcoin derivatives like CFDs and the Crypto 10 index. In this way, investors do not own Bitcoin, they only speculate on its price changes. When you buy, you earn profit when the price goes up, and when you sell, you earn profit when the price declines. Bitcoin trading via derivatives is attractive for many investors because it allows for profits to be captured whether prices are rising or falling. Derivatives can also be traded with leverage, which makes it possible to gain bigger profits when prices move in your favor. So how should you buy Bitcoin? This entirely depends on your investing goals and ambitions. When you buy Bitcoin via an exchange, ATM, or peer-to-peer trading site, you are essentially a hodler. HODL is a term in the Bitcoin community that means holding the coin for a long term. You essentially believe in the future of Bitcoin and will never be concerned by periods where the price is declining. You are in it for the long haul and will cash out when it reaches a predetermined target or when it makes sense to do so. But if you are a short-term active trader, derivatives such as CFDs will suit you better. Bitcoin is generally a volatile asset whose prices fluctuate widely. This means that short-term Bitcoin traders are exposed to more opportunities when the prices swing between different highs and lows. So guys, let me know down in the comment section below, do you have any questions? For more interesting content, give this video a thumbs up and don't forget to subscribe to the channel for more awesome and interesting videos related to Bitcoin. Have a nice day, and I will see you in the next video.